Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I'm going to walk you through the process of valuing Canadian Solar stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Canadian Solar was founded in 2001 in Ontario, Canada. The company has subsidiaries in over 24 countries on 6 continents. They manufacture solar PV modules and in utility scale power projects. With the company's acquisition of Recurrent Energy, Canadian Solar total project pipeline reached 20.4 gigawatts. Let's get started with the model. This is a mid-cap company, $3.8 billion market cap. They're trading at $64 a share and they have 59 million shares outstanding. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company had negative free cash flow in 2017 and 18, but they had over $300 million of free cash flow in 2019. Net income is the profit and loss on the income statement. It's revenue minus expenses. And that seems to be improving. It went from $100 million in 2017 up to $208 million in the trailing 12 months. But it did peak in 2018 at $237 million. Revenue is the sales for the company, and that's pretty steady. It does go up in 2018, but comes right back down in 2019. This is the company's income statement. The top line is the revenue, the sales. That's pretty steady, around $3.3 to $3.7 billion a year. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And below that is their gross profit. Their revenue did peak in 2018. They had a little higher gross profit in the trailing 12 months when compared to 2018 with lower revenue. Below that is operating expenses. Then below that is operating income. So the company seems to be generating a sufficient amount of operating income each year, $200 to $300 million. The company also has a good amount of debt on their books. They had $64 million of interest payments on their debt. Then below that is other income and expenses. This line item is needed because sometimes companies make money or lose money outside of their core operational business. Then below that is pre-tax income, then their taxes. There's also a line item for earnings from equity interest. These are the earnings the company makes from its investments in other businesses. The bottom line of the income statement is their net income, and that was $200 million in the trailing 12 months, up a little from 2019, but a little lower than 2018. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. When you take operating cash flow minus CapEx, it gives you your free cash flow. The company had negative free cash flow in 2017 and 18 because they invested over $300 million into their business. It looks like that investment worked because they generated $600 million of operating cash flow, almost triple of 2018 and 2017. And in 2017, 18, and 19, the company paid down more debt than they issued. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow, you don't have much of a business. And this company has been improving a lot in that category, up to $600 million in 2019. The way you calculate operating cash flow, you start with net income, that was $167 million. Then you have to add or subtract the non-cash items on the income statement. They had $159 million of depreciation, that has to be added back. They also had a positive $188 million in changes in working capital. There's also a $61 million asset impairment. This is when you decrease the value of an asset on your balance sheet and pass through the loss onto your income statement. The company only had $167 million of net income, but net income is not cash, it's accounting profit and loss. The company actually generated $600 million of operational cash flow. Let's look at a capital structure. $1.4 billion of equity, $2.4 billion of debt. They're 37% equity, 63% debt. And their net debt is $1.8 billion. Their weighted average cost of capital is 9.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimate a terminal value, which is all cash flows past year 4, that's $5.6 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.9 billion. We divide that by 59 million shares. And we get a calculated stock price of $83. They're trading at $64, so they're trading at a 23% discount. It's a buy according to the model. Simply Wall Street values the company at $31, so they're saying the stock is overvalued. They're saying it's a sell. I based a lot of my future free cash flow growth off of their 2019 free cash flows and off of analyst estimates. But apparently, me and Simply Wall Street are pretty far apart. The stock was pretty steady for a few years. It looks like the stock price tripled in the past 6 months. So if you bought it down here, you would have a great return on investment. The company's beta is 1.55, so the stock moves 1.5 times the market. The stock has gone up 168% in the past 52 weeks, much better than the S&P 500. The low was $12, the high was $64, and the stock is trading well above its 50-day and 200-day moving average. About 2 to 2.5 million shares are traded each day on this stock, and of the 59 million shares outstanding, 45 million are on float. 48% of the shares are held by institutions. Almost 10% of the shares on float are shorted. If you invested $10,000 into this company 10 years ago and you're still holding today, you would be over $40,000. That's a great return on investment. Although most people would have sold right here because they would have been upset thinking the stock was going to go to zero. When you look on a chart, it seems like it's easy. I would just hold out. But when you look at the stock each day and you see it go down, it's not that easy to just hold out for another decade. The reason the company has a low short percentage is because the CEO of the company owns 24% of the stock. BlackRock owns 6.5%, then Invesco, then Morgan Stanley, then Vanguard. Let's look at their financial ratios. The average PE in the market's 11.3, the median is 14.5. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 18.2, so investors are paying $18 for $1 of earnings. Price to sales is stock price over sales per share. They're at 1.1, much better than the median and average. Price to book is stock price over book value per share. They're at 2.7. That's pretty close to the market median. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $1.4 billion of equity. $1.3 billion of tangible equity, since they have $83 million of other intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They're at 4.5, so they can easily cover their interest payments. ROE is net income over equity. They're at 15%, which is better than the median and average. Current ratio is current assets over current liabilities. They're at 1.1, so they can cover their current liabilities with their current assets. Their current assets are $670 million of cash, $600 million of receivables, and $550 million of inventory. So it does seem like the company does have enough capital to run its business without taking on more debt over the next 12 months, because they had over $300 million of free cash flow. They have $161 million of working capital. The best way to look at ratios to compare them to similar companies, I've done videos on Enphase Energy and First Solar, both in the same industry as Canadian. And if Canadian has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're better in all the price multiples. They're doing worse in current ratio, but they're above 1. They're in the middle in ROE at 15%. They have the most debt of all the companies by far, and they're the smallest company by far. And nobody in this industry pays a dividend. So to summarize, I do have them trading at a 23% discount. I ranked their free cash flow 7 out of 10. Because it improved a lot from the past couple years. It's up to $300 million. Revenue, I rank 6 out of 10 because it hasn't improved much, but it's still $3.4 billion, which is a decent number. Their ratios are pretty good, so I give them 6 out of 10. I don't know too much about their products. The little I did find out about them online, it seems okay. And I don't think they have a big brand recognition. They've been around 20 years, but they're not that big of a company, so I gave them 4 out of 10 for brand. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.